Video opens with a fast-paced montage, a person grimacing at a grocery store receipt, a gas pump with rapidly climbing numbers, a news headline flashing inflation soars, and finally, a confused person shrugging at a wallet full of cash. Host on screen. Asterisk, asterisk. Have you ever felt like your money just does go as far as it used to? That every time you go to the store, your dollar seems to shrink just a little bit more. You're not imagining it. This invisible force eating away at your purchasing power has a name. Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we're breaking down one of the most important concepts in economics: inflation. What is it really? Inflation is the gradual increase in the overall price level of goods and services in an economy. Simply put, when inflation rises, each dollar you have buys fewer goods, your money loses value over time. It's a powerful force that affects everyone from consumers and small businesses to giant corporations and governments. When prices rise too quickly, it creates real-world challenges. Households struggle to keep up as grocery bills climb, rents increase, and loans become harder to afford. For businesses, inflation squeezes profit margins, drives up production costs, and complicates wage negotiations with employees. This isn't just a modern problem. Historically, inflation has shaped entire economies. The 1970s oil crisis, for example, caused massive inflation spikes in the United States and Europe, leading to a painful period of economic stagnation and high prices known as stagflation. More recently, the post-COVID era brought a stark reminder of inflation's power. As global supply chains collapsed and government stimulus fueled a surge in consumer demand, we saw firsthand how inflation isn't just a theoretical concept. It's a living force that shapes our daily lives. So, how do we even know how fast prices are rising? Economists have a toolkit of key indicators they use to measure and monitor inflation. The most well-known is the CPI, or the Consumer Price Index. The CPI tracks the average price change of a basket of goods and services that a typical household buys, including everything from food and rent to fuel and healthcare. Think of it as the economy's shopping list. Another crucial tool is the PPI, or Producer Price Index. This measures the change in prices that domestic producers receive for their output. The PPI is often seen as a leading indicator, as price increases at the producer level tend to eventually make their way to consumers. To get a clearer picture of the underlying trend, economists also look at core inflation, which excludes volatile items like food and energy, prices that can swing wildly from month to month. Data for these indices is gathered monthly through extensive surveys and sampling across countless industries. The results reveal not just how fast prices are moving, but also where the pressure points are in the economy. Based on this data, most central banks, like the U.S. Federal Reserve, aim for a sweet spot, an inflation target of around 2%. This modest level is believed to be healthy, as it encourages spending and investment while keeping prices stable and predictable. If inflation rises too high or falls too low, the central bank intervenes with policy adjustments to steer the economy back on course. Now, let's dive into the three main drivers of inflation. The first is what economists call demand pull inflation. This is the classic scenario of too much money chasing too few goods. It happens when the total demand in an economy from consumers, businesses, and the government grows faster than the economy's ability to produce goods and services. When everyone is spending aggressively, Perhaps after an economic boom or a large injection of government stimulus, supply simply can't keep up. With more buyers than sellers, prices naturally rise. A perfect example was the post-pandemic recovery in 2021. Households flush with stimulus checks and accumulated savings rushed to buy cars, electronics, and homes. At the same time, global supply chains were still heavily disrupted, meaning there were fewer products available on shelves and in showrooms. The result was a dramatic surge in prices across nearly every sector of the economy. In response to this kind of inflation, central banks often step in by raising interest rates. Higher borrowing costs make it more expensive for people and businesses to take out loans, which discourages spending and investment, helping to cool down the overheated demand. Visually, you can imagine the economy's demand curve shifting sharply to the right, while the supply curve stays put. It's the same amount of stuff, but far more demand, leading directly to higher prices. The second major type of inflation is known as cost-push inflation. In this case, prices rise not because consumers are suddenly buying more, but because it has become more expensive to produce things in the first place. There are several common triggers for cost-push inflation. For instance, a sudden spike in oil prices makes transportation and manufacturing more expensive, which pushes up the price of nearly everything that needs to be made or moved. Similarly, when wages climb significantly, businesses often pass those higher labor costs on to consumers in the form of higher prices to protect their profit margins. Global shortages of key materials like the semiconductor crisis or disruptions in wheat supply can also slow down production and cause prices to spike. This type of inflation is particularly difficult for policymakers to manage. Raising interest rates to curb demand won't make oil cheaper or magically fix a broken supply chain. That's why cost-push inflation often lingers longer and can be more stubborn than its demand pull counterpart. A recent and powerful example was the 2021 to 2023 energy crisis, where geopolitical tensions and supply disruptions caused natural gas and oil prices to surge globally. Businesses faced cripplingly high energy costs, and those costs were passed directly to consumers through higher utility bills and more expensive goods. Finally, we have what might be the most fascinating and human type of inflation: expectation-driven inflation. This form is driven almost entirely by psychology and collective behavior. It works like this. When people expect prices to rise in the future, they act in ways that actually cause prices to rise. It becomes a self-fulfilling prophecy. For example, workers might demand higher wages to keep up with inflation, which forces businesses to raise prices. Businesses, in turn, might raise their prices in anticipation of facing higher costs for materials and labor down the road. And consumers, fearing that prices will be even higher next month, might rush to buy big-ticket items now, which further fuels demand and pushes prices up. This creates a dangerous psychological spiral, where the expectation of inflation becomes the primary driver of actual inflation. Central banks spend enormous effort managing these expectations through clear communication and by establishing their credibility. If the public trusts that the central bank will do whatever it takes to keep inflation low and stable, people behave accordingly, and that stability is maintained. A classic historical case study is the United States in the 1970s. Inflation expectations spiraled out of control, creating a vicious cycle that seemed unbreakable. It took the legendary Federal Reserve Chair, Paul Volcker, to finally break the cycle by raising interest rates to record high levels, causing short-term economic pain, but ultimately restoring public trust in the Fed's commitment to price stability. So, with all these forces at play, how do governments and central banks actually fight inflation? They use a combination of monetary and fiscal policy tools. On the monetary policy side, the central bank is the main actor. It can raise interest rates to make borrowing more expensive, which slows down spending and investment. It can also reduce the money supply or sell government bonds through a process called quantitative tightening, both of which work to remove excess cash from the financial system. On the fiscal policy side, the government can play a role by cutting public spending, raising taxes, or reducing subsidies to help cool down excess demand in the economy. Timing is absolutely critical in this fight. If policymakers tighten policy too late, inflation can spiral out of control and become deeply entrenched. But if they act too aggressively or too soon, they risk tipping the economy into a recession by choking off investment and increasing unemployment. We've seen this delicate balancing act play out in real time across the globe recently. The U.S. Federal Reserve's series of interest rate hikes from 2022 to 2024, the Bank of England's gradual tightening, and the European Central Bank's reduction of its balance sheet were all strategic moves aimed at bringing inflation back down to their 2% targets without causing a deep economic downturn. It's important to remember that not all inflation is bad. In fact, a moderate and predictable level of inflation is often a sign of a healthy, growing economy. It encourages businesses to invest and consumers to spend rather than hoard cash, which keeps the economic engine running. The real danger that economists fear even more than high inflation is deflation, a period of consistently falling prices. While it might sound good, deflation is disastrous. It discourages spending, while by today, when it will be cheaper tomorrow, increases the real burden of debt and can lead to long-term economic stagnation. As seen in Japan's infamous lost decades, therefore, the ultimate goal for policymakers is to strike a delicate balance, keeping inflation low, stable, and predictable. A little bit of inflation, it turns out, is the price we pay for long-term prosperity and innovation. So, to wrap it all up, inflation is so much more than just a headline about rising prices. It's a complex reflection of how supply, demand, production costs, human psychology, and government policy all interact within an economy. The next time you hear a report that inflation is rising, you can now ask the more important question: why is it demand pull inflation? Driven by too much spending? Is it cost push inflation caused by rising production costs? Or is it being fueled by expectations, a behavioral loop that's hard to break? Understanding these distinct forces allows individuals, investors, and policymakers to make smarter financial decisions, prepare for future economic changes, and interpret global market trends with far greater intelligence. The final message is this: inflation isn't just an abstract economic statistic. It's a story about human behavior, the limits of production, and the constant, delicate dance between growth and stability that defines our modern world.